A 10-year government bond yield is not one number, it is secretly two. One part is what the market thinks short-term interest rates will average over the next 10 years. The other part is a hidden extra, the compensation investors demand simply for locking their money up that long. That second piece has a name: the term premium. In late April 2026, a widely used model split the 10-year yield of about 4.5% into roughly 3.7 for the expected rate path and about 0.7 for the term premium. That small piece is one of the most important numbers in finance, and it just woke up. Why should you care about a piece of a yield? Because it decides whether long bonds behave the way everyone expects. Here is the payoff up front. The term premium spent most of the last decade near zero or below zero. By late June 2026, the same model put it at about 0.5%. Positive for the first time since 2023. When the term premium is negative, investors are effectively paying for the privilege of holding long bonds. When it turns positive and rises, they demand to be paid more to wait. That single shift can push long-term borrowing costs up for governments, companies, and mortgages, even when nothing changes about where the central bank is headed. Let's back up. How can a premium for waiting ever go negative? For most of history, it was positive. You wanted extra yield to take the risk that rates or inflation might rise before your bond matured. Then two forces flipped it. First, years of low, stable inflation made the future feel predictable. Second, central banks bought trillions of dollars of long bonds through quantitative easing, soaking up the supply and crushing the extra yield. The result? The 10-year term premium went negative for the first time in 2014 and stayed low or below zero for much of the decade that followed. So the real question is what changed and why the premium is climbing back now. Here is the machine that moves the term premium. Think of it as the price of two worries plus supply and demand. Worry 1, inflation uncertainty. If the future path of inflation feels less predictable, investors demand more yield to hold a fixed payment for 10 years. Worry 2, interest rate risk. The longer the bond, the more its price falls if rates rise, so longer bonds carry more of this risk. Now add plumbing. When governments run large deficits, they issue a lot more long-term debt, and someone has to be paid enough to hold it. At the same time, central banks running quantitative tightening are shrinking their bond holdings instead of buying, removing a huge, price-insensitive buyer. More supply, fewer forced buyers, and more uncertainty all push the same lever. Investors ask to be paid more to wait. That is a rising term premium. So what does this actually do to a portfolio? It breaks a comfortable assumption. For years the reflex was simple. When the central bank cuts rates, bonds rally and long yields fall. But that only holds if the term premium stays put. In 2026, it did not. When cuts are expected, the front end of the curve, the short maturities, can fall as it prices those cuts in. Yet the long end can stay stubbornly high if the term premium is rising at the same time, offsetting the lower expected path. So the 10-year can refuse to drop even as the policy rate is coming down. The expected path pulls one way, the term premium pulls the other, and the long bond sits between them. So here is the lens to keep. Anytime you see a long-term yield, remember it is two numbers wearing one coat. The market's best guess for future short rates, plus the term premium it charges to wait through the uncertainty. When the premium is negative, the long bond is expensive and calm. When it turns positive and rises, waiting costs more, and long yields can stay high for reasons that have nothing to do with the next rate decision. It does not tell you where yields go next, but it tells you which force is in charge. So the next time long yields refuse to fall, don't just watch the central bank. Ask what the term premium is doing. This channel explains how markets work. It is educational, not financial advice.